Hello everyone, welcome back. This is the fifth of our ACCA F9 lecture recaps. This is a recap of our lecture on working capital. Remember, you can download the PDF of this or any of our mind maps for free on our website. Working capital then, the components first of all we discussed were initially our current assets, the first part of it, so that's our inventory, our receivables and our cash. Remember, cash is slightly different. All of our movements will go through cash, but it's still a component. We still have to fund it in some way. And also our current liabilities, which is our payables. So our current assets, inventory, receivables and cash, and our current liabilities, which are our payables. The next thing we needed to think about was overtrading. A lot of questions on F9 discuss overtrading, but what is it? Well, it's a lack of cash to support the business. So it's a lack of cash to support the business. Remember, you can have a business that's making lots of profit, but profit's not cash. So having a lack of cash can damage or ultimately sink the business. So signs of this then, signs of overtrading. First of all, rapid expansion. So you're expanding really rapidly. You're selling lots of goods, but you're maybe not getting the cash in for those goods. So that will lead to a stock build-up as well. So maybe you're buying in lots of stock thinking you're going to sell it, but again, that's tying up cash. So lots of stock building up, tying up cash, sign of overtrading. Lax credit terms. So having lax credit terms means that you're giving maybe too much time for your customers to pay you. Or you're maybe paying your suppliers too quickly, and that means you're burning up cash again, and you'll eventually run out of cash. You're overtrading. Also, a reliance on short-term finance. Remember, you've got two sources of short-term finance. Number one, your overdraft, and number two, your payables. So remember, we said in the lecture, make sure that you think of payables as short-term finance. It's free short-term finance. So overdraft and your payables are your short-term finance. If you're relying too heavily on these though, they can be withdrawn at any time. Again, a sign of overtrading. Also, we can have a deteriorating current ratio, which is our current assets over our current liabilities, or a deteriorating quick ratio, where we take inventory out of our current assets and put it over current liabilities. Remember, these will tell us how much current assets or how much liquidity we have in relation to the current liabilities we're going to have to pay. If they're deteriorating year on year, that's a sign of overtrading, and we did an example of that in the lecture. The working capital cycle then, well, this is it. It's our inventory period plus our collection period less our payables period, and that gives us our cash operating or working capital cycle. To calculate each of those, we had our inventory period, which is our inventory over our cost of sales times 365. Our collection period, which is our receivables over our credit sales, making sure it's credit sales times 365, because remember, cash sales will just be given the money instantly. And payables period is our average or current payables over our credit purchases times 365. And we did a really detailed illustration of this, redoing our balance sheet to show how different working capital cycles will affect our cash balance. So make sure that you go back over the full lecture and understand how that working capital cycle works. The next thing we needed to know about working capital was how working capital is financed. So working capital financing, make sure that you know the distinction between your working capital cycle and working capital financing, because they're completely different areas. Working capital financing, well, we talked first about our types of asset. We talked about, first of all, our fixed assets. Remember, that's just our plant, machinery, etc. We then talked about permanent current assets. So these were the current assets that you'll need day to day. We're thinking about inventory and receivables, and we said that you're going to need some level of inventory and some level of receivables at all times, a level at which those do not drop below. So you need some inventory and some receivables, a minimum level to run the business day to day, and that's your permanent current assets. You need those at all times so they're permanent, as opposed to fluctuating current assets, which means that your inventory and receivables will sometimes go up and sometimes go down. So there will be seasonal effects, but usually these will be short term. So that means that the fluctuating current assets go up and down over short term periods. The question is then, how do we finance this? How do we finance each of those types of asset? Well, we have short-term finance, and remember that's our overdraft and our payables. The key thing on this is that it's cheaper. Remember, your payables are free, your overdraft will be cheaper than long-term debt, so short-term finance is cheaper. Long-term finance will be your long-term debt, and that will be expensive because it's over a longer term, it's higher risk for the person that's lending to you, so it'll be more expensive. And we looked at how we use these to fund our assets. The matching principle first of all said that we match short-term assets with short-term finance and vice versa. So long-term assets with long-term finance. So that was the matching principle. But we then looked at a diagram, and this is the diagram we looked at. Our diagram to describe working capital financing was this one. On the left hand side we have a graph. It shows our fixed assets up to the straight blue line, our permanent current assets up to the straight red line, and then our fluctuating current assets moving up and down above that. On the right hand side we have short term finance at the top, which remember is cheaper, our overdrafts and our payables. Our long term finance at the bottom, which is more expensive. So our aggressive approach to working capital financing, we used our short-term finance to finance all of our fluctuating current assets and some of the permanent current assets, even though they're permanent. On the conservative side of things, well, there we funded all of our fixed assets and all of our permanent current assets with long-term expensive finance, and also some of our fluctuating current assets with that long-term finance. On the moderate side of things, we undertook a matching principle and we matched our permanent and fixed assets with our long-term finance, and we financed our fluctuating current assets through short-term cheaper finance. So as we saw with the diagram then, an aggressive policy meant that we funded some of our permanent current assets with short-term finance because it's cheaper. We're thinking of our overdraft and our payables. And we did that because it's cheaper and we can make more profit. So funding some of those permanent current assets with short-term finance. Why should we not do this? What are the disadvantages? Well, the finance can be withdrawn. The bank can take your overdraft and your suppliers can stop financing you. You can also annoy your suppliers by not paying them and annoy customers by putting pressure on them to pay you. So that's the problems with an aggressive policy. The conservative policy, well, remember the benefits of this are that there are less liquidity risks. So it's less chance that you'll go out of business through a lack of cash. You can also meet sales demand changes because you've got some capital available, because you've got some of your short-term finance available. And also giving credit can give you more sales. So you're giving more credit, that may lead to more sales. The downside of a conservative approach is that it's inefficient and it's less profitable. The moderate approach then, well, it was effectively our matching principle and it achieves a balance between the conservative and the aggressive policy. So make sure you can draw that diagram, draw it out in the exam and discuss it, and you'll get a working capital financing question right every single time. So that was our lecture on working capital.